Hello, everyone. Welcome to another live webinar show gearing up for MooFest this year. We're kicking it off with our online series for our live funds webinars. And so this is the first show out of the many that we have geared up for you. Now, if you want to find out what the topic is all about, you'll have to stay tuned for after this video. Enjoy. Welcome back, everyone. Once again, you're with me, Olivia Higgins, and today it's the first of the many shows we have lined up for you as we gear up towards the exciting MooFest for this year. It's just around the corner, so if you want to check out more details of that, I'll share it at the end of the show, or you can go into the description box and see it for yourselves. Now, before we begin, remember that today is all about education, okay? So don't take anything as financial advice, and remember that we're here to network, as always, in every live show with the community, whether you're tuning in app or on YouTube broadcast channels. Do drop in your questions because we're hearing you and we're listening to you, okay? So type in your questions, and at the same time, we're actually having some surprise giveaways, and it comes in the form of a quiz. So you know the drill, how it works. If you do get the right answers, you'll have to type it in the box as fast as you can, and make sure that you stay till the end because we have several giveaways for the quiz for you, okay? So with that, let's start the first show for our Funds Live webinars. Now, today's topic is Beyond the Technology Rally, what's next? I know we have so much talk in the forums about NVIDIA, a lot of the key names, right, of the recent activities that has happened with technology stocks. Now, we do want to take a more macro approach this time and come from a global market outlook angle, and also explore potential other markets that you could see really in the re-strategizing of your own portfolios as we proceed on to the second half of the year. So today, really ask your questions, network at the same time. You'll be rewarded if you stay till the end with our quiz questions. So let's begin. Introducing from Fidelity International, the client portfolio strategist, Christopher Wong, everybody. Welcome back to the show, Chris.
Hi, thanks for having me.
Thank you so much. Well, we've done several shows together, but of course, for those people who are new to you, do introduce yourself and also tell us about the objective of the show today.
Yeah, sure, Olivia. Good morning, everyone. So I'm Chris Wong from Fidelity International. I'm a client portfolio strategist, Southeast Asia. So today, really like what the title suggests, right? We want to share what we think might happen in the second half of the year, especially after we've seen the blistering run in technology stocks this year. So what should investors consider within their portfolios?
Absolutely. And I love that we're starting off this topic and also the series with that, because in the past few weeks, we have heard a lot about the technology rally and also a lot of investors that are tuning in right now. They've got a lot of questions on this. So let's just kickstart this with just a general outlook question. So, Chris, just even from a house perspective, what is that sentiment, or what can we be looking out for potentially as an overview to begin with?
Yeah, I think that dovetails nicely. Maybe let's start a bit on the macro outlook. Let me just
Mhm.
spend a couple of minutes there. So maybe if we can just bring up the slides here. So today, really, what we want to touch on upon is the topic beyond the technology rally, what's next. But maybe as a start, yeah, so touch on Fidelity as a firm whom I represent today. So we're a fully independent, privately owned asset manager. So we're not part of any bank or financial group. So our sole purpose here is really to manage money, deliver investment results. And because we're privately owned, there are no quarterly short-term financial goals reporting to achieve. So we really focus on long-term outcomes. As a firm, 50 years of heritage, we manage more than 800 billion currently of assets globally across asset classes. And where we're the most proud of is bottom-up research, with a focus of putting boots on the ground to understand every single investment we make. And on the next slide here, really is just a bit of a recap of award season. So some of the awards we've won through recent times. Let's start a bit on the macro outlook proper, and I'll lead you to the next slide. So here really summarizes what we view of the macro outlook so far. On the next slide, please. So at present moment, from an economic standpoint, soft landing is our current base case, right? But while economic data so far has been strong, there are also increasing signs that the economy is slowing, and we may face some headwinds in the coming months and quarters, and that's something we are watching out for. Now, inflation, that's the other factor the Fed and the investors are focused on. Inflation is falling. Recent inflation data also shows that inflation is increasingly coming under control, right? Going forward, so we look forward, there are several factors that might drive this further downwards. A softening labor market, companies starting to reduce retail prices, increase promotional prices. So if you look at the US, there's several companies actually doing more discounts or bringing out more value meals, value items, and that could bring inflation down as well. Falling home prices. So these are some of the factors we are watching, and hopefully they start to bring inflation further down. Besides that, I guess everyone is also keen to know what's happening in China. So this year, Chinese data, economic data have improved, and China really stands out. It's the only economy, major economy at least, in easing mode, looking to further ease, and that we should see some stabilization there. From an economic perspective, we should be past major economies' monetary policy cycle peaks. The Fed is likely to cut rates this year. Markets pricing 2 times about this year from September onwards. They will be very data dependent. So in the slide you're seeing right before you, this just plots the activity trackers we're monitoring the US and Europe. We've seen activity notably pick up since the bottom of Q3 of 2022, and we're seeing resilient economic data so far. But like I mentioned, some of the forward-looking data seems to suggest we should see a slowdown happen in the short to medium term. So that's one to watch out for. On the next slide, here we just plot and detail a little bit inflation, right? So here you see the chart on the left represents inflation, actually both charts, across regions globally on a clear downtrend. And we do see room for inflation to further fall, like I mentioned a bit earlier as well, right? So goods prices coming down, more promotional kind of items coming up that should bring inflation down, labor market softening, etc. So that's on inflationary front. And on the next slide, so we're potentially seeing slower economic growth, inflation come down, then the next question, what will happen to interest rates? So like I did in my opening summary, markets pricing 1 to 2 rate cuts this year, potentially from September, and really what will happen from here on will be very much data dependent. So we expect central banks to be very much focused on data as they come out rather than trying to make forward forecasts, because in the last 1 to 2 years, it's proven to be a bit less helpful, a bit more futile. So they will be very much data dependent. So watch this space as well. And the last part here on the next slide, 3 scenarios we have for China for the rest of this year. From our perspective, China should see a controlled stabilization. supported by targeted policy easing measures. So the ongoing cycles has been benefiting exports, and that's been a main driver of growth. Property, right? Everyone's watching out for that. Has been a drag so far in the last 1 to 2 years. That's looking to be more stable from here on. We have seen measures to stimulate demand, and hopefully that helps to further stabilize the situation. Inflation, not much of an issue in China. In fact, they are grappling with deflation, right? So that gives them room to further ease policies. We expect them to do that selectively with a focus on maintaining liquidity and potentially fiscal easing as well. On the next slide, here we just highlight some of the policy easing and kind of regulatory pressures that have eased significantly. So in the chart before you, it plots policy tightening or loosening measures on privately owned entities in China. And very clearly in recent times, we have seen policies become a lot less kind of tight, right, on the private sector, and that should help the economy. And on the next slide, just a bit on the consumer. So consumption in China arguably has been a bit softer. It's been a driver of growth in 2023 after the zero COVID policy was released, but since has slowed a little bit, right? Consumption in China tends to be led to the property sector and employment. And going forward with the property sector stabilizing, that should help sentiment, right? And with this potential slow but recovery, we should see incomes also recover. We should see unemployment expectations rise with the economy, and that should help consumer confidence come back a little. And based on more recent surveys like the depositor surveys, consumer confidence index, we're seeing consumer confidence tick up a little bit as everyone feels a bit more confident than before to consume more, and all of this are positive signs. And on the next slide, and it's just the last kind of topic I want to touch on a little bit, markets, right? Because we were talking about investments here. How have markets done thus far in 2024? So far, we're seeing generally, you've seen a slide before you, equity market returns. Generally strong markets with US technology leading the way in dollar terms, but market breadth has been pretty narrow. Much of this year's return been led by developed markets, US especially, and the tech sector, right? Other areas you see on the right, India, Japan have done well, but Japan's returns are a bit poorer if you reflect this back to dollar terms. This is in yen in the bar chart before you. So, and the weights on Japan, India, a lot smaller than the US, hence they haven't had that much impact. So this year in the equity world, it's been very much still driven by the US, by the technology sector. And on the next slide, from a fixed income perspective, you do see it a bit diverging a bit more. Higher riskier credit markets like high yield have done better than investment grade bonds, and that again creates opportunities. So on the next slide, earnings expectation, we expect to see generally healthy earnings, corporate earnings growth this year, led you see by the bar chart bottom two, IT and related sector communication services. Besides that, other sectors like financial staples, discretionary healthcare should see pretty nice single-digit earnings growth this year as well. And on the next slide, just really putting all of this together, there are several themes investors can really think about through the course of the 2024, rest of it at least. Interest rates likely to come down. Investors can consider putting a bit more cash to work. Second, uncertainties remain on the horizon, but with uncertainty comes opportunities, right? So be selective, yet diversify, if that makes sense. The rally has been narrow so far, so investors can consider really areas that have lagged so far, valuations a lot less demanding, positioning less concentrated. So really, from what I've kind of discussed over the last 10 minutes or so, these are some of the themes, kind of portfolio decisions one can really think about for the rest of the year. And with that, hand the time back to you, Olivia.
Thank you, Chris, for that, because you really answered some of the questions already coming in from our audience members online, especially in-app. And thank you for those who just joined us. Remember to stay till the end because we got some surprise giveaways for you, okay? Next question, Chris. You mentioned about markets being very concentrated. Now, could you just elaborate a little bit more on that? And does it now mean that opportunities potentially that lie outside of yesterday's winners, how could the users or investors tuning in make sense of that?
Yeah, let's maybe hop on to slide 17, just to give a bit more perspective of how narrow it's been thus far. So it's been really, you see the chart before you, several years in the market where investors have been crowding into a real literal small handful names of a basket of stocks, right? So you see, for example, in the year of 2023, this group of stocks now termed the Magnificent Seven, they contributed to 40% of global equity returns, 60% of US equity returns. And this year it's been quite the same, right? Breadth has remained very narrow. So one particular stock, I think everyone's very familiar, Nvidia, it's contributed about a third of returns so far in the US. The next five stocks after it, about a quarter of returns. So it's been very narrow. And really, there is room for broadening to happen. And right in the slide before you, this gives it a bit more color. So you see the bar charts, they represent the percentage of companies in the S&P that outperform. So in 2023, only 27% of companies outperformed. And the last time we saw something as such was during the tech bubble, right? So on average, you see through a couple of decades, on average, 40+% of stocks will beat the market on average, right? At some point, this 27%, 20+% should converge back to 40% as breadth widens. And that really is the opportunity outside of this Magnificent Seven or the mega cap, large cap stocks. On the next slide. So the area really that has driven, like I mentioned a couple of times, US and tech, and that's where the opportunity lies. So in the chart on the left, we plot kind of valuations of different tech sectors across regions, right? And tech companies are a good example. They tend to be quite global. Their products are universal and not really narrowed to a specific region, a bit of tweaks here and there, right? So for example, an app, a software, a semiconductor product is largely applicable across the world. Yet valuations in US is a lot richer than somewhere else. And the same on the right, something like staples we use day to day. So given again, very global nature of these product lines, they are very comparable, right? So for example, a Unilever in the UK, very global, 45% of revenue from emerging markets, 40% from US, 20% from Europe, versus a company like P&G in US, 50+% also from non-US markets. Very comparable, but you do see the valuations diverge quite significantly in recent years. And again, from a global lens, when you think about it, there are opportunities outside the US that one can really think about because valuations are a lot more attractive or less demanding there, right? So on the next slide, so in the slide before you really takes me to what I want to share this morning as well. Beyond the large mega caps, there are two areas one can think about in their portfolios, or they can put them two together, right? One, in the tech space, but beyond the large mega cap, beyond the US-centric nature, right? Some of the companies there. On the other end, more defensive dividend stocks, which currently are trading at very undemanding valuations.
Thank you, Chris, for highlighting that. So I think that in itself, we already have questions, but of course we can take on the add-ons later on during the live Q&A segment. Okay, so everyone keep your questions coming in and what you'd like to ask Chris for this topic for today. Now, the next question is about tech, of course, right? Because we're going back to the topic of today, which is beyond the technology valley and what's next. But before we look into that forward-thinking approach of what's next, we do have to look at tech itself first, especially now that it's on the top of the mind concern for our active investors right now. So is tech too expensive right now?
Yeah, no webinar is complete without talking about tech, right? So, okay, maybe
Absolutely.
let's start on 22, please. Just let's delve a bit more on tech. So, we've seen in the chart before you really a tale of two halves, if you may, over the last 2 to 3 years. So, 2022, a rough year, right? Rising interest rates from 0 to 5.25 in quick time. Hence, that really hit tech stocks quite hard. But year 2023 till date, we are seeing quite a nice recovery. And if you do stretch this chart over a much longer period, the tech sector has outperformed the rest of the market quite consistently and the majority of the calendar year. So that speaks to the strength of the tech sector, right? And the innovation, the growth that's happening. Now, on the next slide, I guess the other question is the tech sector too expensive? So here we plot valuations of the sector versus the broad market. Yes, it tends to trade at a premium. And yes, currently it's above long-term averages, right, versus the broad market. But you do make a few observations here. Valuations are still below where we were GFC, before the tech bubble, for example, and COVID as well. And like I mentioned, a lot of this has been driven so far by a handful of stocks. So if you strip out that portion as well, the rest of the market, the valuations are less demanding. So really, be selective here, but we still say there are opportunities. And on the next slide, just to remind everyone, I'm sure it's everyone knows this very well. Tech is advancing very rapidly. So just a few statistics really to hammer this home, right? So an estimated 130 devices are connected to the internet every second, right? So based on Gartner, so a consultant's estimate, a 4.7 trillion global tech spending was achieved in 2023, expected to grow about 8% this year. And this number doesn't fully incorporate as well the potential spend related to generative AI. So the impact is probably going to be a bit later. In recent corporate earnings calls, so for example, the fourth quarter earnings call, the number of S&P companies discussing AI has climbed to new highs, right? So it's about 36% of companies spoke about AI, and that really speaks to the trend that's upcoming as well. And in the chart before you, it plots the kind of how fast technology is adopting. So it shows the different platforms, how long it took for them to reach 1 million users. Netflix, that feels like a long time ago, 1,300 days.
Mm-hmm.
Instagram, 76, ChatGPT, 5. So really things are accelerating here, but really the key here is to focus on valuations, focus on earnings, focus on the growth outlook, companies that can grow earnings short through medium term. And with also investor positioning, you want to be a bit more careful, not overly allocated in names that are very, very popular, well-owned in the market space.
Mm-hmm. Thank you for that. Keep those technology questions coming, okay? Because we're looking at them and we'll pick the best ones for the second half of the live webinar. Now, you spoke about looking beyond the winners of yesterday. Now, how does one apply this in the tech world currently? And how do we really think out of the box right now in terms of our current portfolio?
Yeah, so how we want to think about technology, you see that on slide 25. Technology is more than the obvious beneficiaries that appear on the surface. So the best way to illustrate this in our mind is an iceberg. So the top of the iceberg, I think that's what we tend to imagine or link technology to, right? E-commerce and the likes. But if you look beneath the iceberg, there are many opportunities that are out there, maybe not so well invested or understood. For example, you might have online travel agencies, right? We now don't go to physical ones, we go online, the OTAs. These guys are technology companies, but they may not be classified as such by a typical index provider. Or payments, right? We do e-payments. These are also may not be classified as technology from a index provider perspective. Or even we think a lot about enablers of technology, but there are adopters of technologies in traditional sectors that use technology to improve outcomes. Give you an example. In the industrial space, we have found an aircraft engine manufacturer that uses technologies in multiple ways. So one, improve its production process. And two, whilst the plane is flying, right, the engine captures a lot of information. They use that information, it's fed to the ground in real time. They analyze it, figure out the health of the engine, figure out what maintenance needs to be done. So a lot more preparation work can be done earlier. Efficiency is achieved for their clients. So really, if you widen your lens and think about it from this perspective, adopters in this last case I quoted can also be deemed as good kind of big adopters of technology to improve their outcomes. So really that widens your breadth. You can capture more trends and also diversify the exposure you get in technology. Right, on the next slide. So on the theme of looking beyond the winners of yesterday's, for example, the other area we're looking at, for example, is small mid caps, right? So the chart before you shows plots two things, right? So one in blue, the broad tech sector, orange, performance of small mid caps since the market bottom late part of 2023, and you see a clear divergence, right? So large cap, the market has been driven a lot by large mega caps that has outperformed small cap by quite a bit. And many small caps, mind you, have the potential to be winners of tomorrow. They have good innovative technologies, growing user base, growing scale that can potentially displace existing technology some point in the future. So they're potential winners of tomorrow. So that's one. And two, because a lot of them hold strategic assets, they can be M&A, merger and acquisition targets, right? Given that they have underperformed, they're not as expensive, they could also be acquired. And that's another theme that we're looking at, thinking outside of the winners yesterday. Some of these M&A small cap names can potentially be acquired, acquisition targets, and that can deliver alpha to investments as well. And that's what we're doing in our portfolio. And on the next slide, really just something that we have done through time. So through the course of the strategy or tech strategy, we've done a number of we have seen a few acquisitions. So for example, in 2016, acquisition of LinkedIn, which many of us are on a daily basis, acquired by Microsoft. Red Hat by IBM in 2018, or last year we have 4 acquisitions. So small mid-caps offer quite good exposure as well to technology, winners of tomorrow, and also potential acquisition targets. So that's one that we're expressing in our portfolio. And on the next slide here, maps out some of the long-term themes. We're also spotting quite a number. I won't go through all of them, just to flag out a few. 5G. Now, while we are very familiar with 5G in our world, in Singapore, in Southeast Asia, many parts of the emerging world are only starting to kickstart or accelerate their 5G transition. And that, in our mind, will lead to kind of replacement of handsets, low-end Android handsets, a lot of semiconductors, hardware cater to this space, and that's where we're finding some opportunities. Cloud, for example, penetration early innings, potentially going to accelerate because of AI, right? And that's a trend that we're spotting. Digitization, for example, another one. So there's rising penetration in our daily lives, right? E-commerce, trip bookings, etc. Right? Habits take a couple months to form. Once they form, you stick to them, right? So there is a lot more room for a lot of traditional industries, consumer industries to continue digitizing, and that's another trend we are spotting. And of course, AI, right? So exciting area, going to benefit many areas from agriculture, from chatbots, from consumer relationships through to the creative industry. So that's another area where we're keeping an eye out on. So broadly, this is what we're seeing from a tech perspective. And on the next slide, I guess I will preempt some questions and let's just talk a little bit to AI, but I'm happy to delve into it later. So AI is a long-term opportunity, right? It's going to create a lot of opportunities, but really when we talk about AI, it's really quite vast, right? And we tend to look at it as a tech stack, right? So this time I'm just laying out in a horizontal manner, very simplified, but gives you a broad idea what's happening in the broad value chain as with how we produce tables and chairs. There's a value chain to this. And it's a lot more than NVIDIA or some of the names we read a lot in the media, right? So for example, on the extreme left, in semiconductors, within that, there are chip designers, fabrication companies, equipment manufacturers, memory names. So that's where multiple opportunities are that we're kind of trying to sift through to look at it. Down the value chain, cloud providers, a lot of data will be created and cloud will be an essential pick and shovel, if you may, part of this entire ecosystem. Data platforms, you do see names that create clean, organized data. So you need good data to go in for generative AI to learn, right? So these guys do help the entire process. There are data platforms. For example, I mentioned AI services, consultants to help firms be ready, their workforce be ready for AI, right? That's also actually part of the value chain. And at the end, names that use AI in their processes to improve outcomes. So really, from an AI perspective, it's long drawn. We agree with that, but one can also sift through the value chain to pick opportunities here. So really, I hope the message I brought to you is there are many trends happening. Beyond the large mega caps, there are opportunities in many places like small mid caps, for example, or even through the AI tech stack, different pockets you can think about. And that's what we're doing in our strategy.
Thank you, Chris, for that. Now, Fidelity currently manages one of the largest global technology strategy funds, and also the asset under management is over US 20 billion. So, just for the users out there to help them understand more, could you just share a little bit more on the track record and also the approach to tech investing, and to be specific on this?
You see that on slide 30, a bit on our long-term performance versus benchmark and peers. And what we do other than do well on absolute terms, we do that with lower volatility and the gyration we do tend to time see when markets get a little bit uncertain. It tends to be much more moderate as well. So a superior long-term risk reward profile. And on the next slide, here's where you'll see us being a bit different from kind of index, ETFs, active funds out there. So from a geographical perspective, right, allocation much more spread out and much more global. US, while it's our largest absolute position, we are quite underweight here, right? So we don't have as much exposure to large mega cap companies in the index. We spread our allocation as well through Europe, through Asia Pacific, and from a market capitalization perspective, we are more small mid caps. And on the sectoral perspective, while IT is still a bulk of it, we are underweight, right? We do have exposures to other sectors that are very much related to technology, communication services, discretionary, industrial. So the aircraft engine manufacturer will probably sit here. We have some financials, payment-related names. We even have real estate names, so REITs that are linked to data, kind of towers and data passing through them, good cash flow, high dividend names, relatively defensive, adds to our diversification. So really, Olivia, how we're really different is you can clearly see from a geographical and a sectorial perspective, we are very different from the index. And if we look us versus other active ETF or ETFs in the market, we are quite different in this aspect as well, right? And on the next slide, here's just a summary of the portfolio characteristics as we speak. Close to 100 stocks, so 97 at present moment. Turnover relatively high, so we turn over the portfolio on 70% on average right now. Active share, which is essentially a measure of how different we are from the index, is about 70% plus, meaning we're quite different from the index as well.
Mm-hmm. Thanks for that. Now, as we transition towards the end of our fireside chat, and again, to the users, I hope you've been paying attention because we'll have our first quiz giveaway at the end of this. Okay, so stay tuned. All right. Next question. We have many investors. They're drawn quite highly to the high growth tech stocks. Now, we have also seen dividend investing continue to be a core part of our investors' portfolios. Now, what is dividend investing and why is it attractive for the investors?
Yeah, let's hop on to slide 34 then, right? So we find everyone's been very much gravitated to growth, thematic investing, and for good reason, admittedly, but dividend investing has been broadly underappreciated. So let's go to slide 34, please. And we find dividends are still very important components to long-term returns, right? So in the chart before you, plots kind of global equity returns, breaks them down, and you do find dividend returns are a big part of this total return experience, more than 60% through time. Highlights the importance of dividends. And a few interesting things to note as well. You do see gyrations in stock price, especially in periods of crisis. Dividend tends to be much more resilient. And when you put them together, it results in a less volatile, a bit of a smoother experience or ride, if you may. So dividends have a strong role to play in that sense. And on the next slide, dividend yields, right? So dividend yields tend to be quite stable across cycles. And if the expectations by the market for interest rates cuts to happen from this year onwards, this dividend yields will increasingly be more attractive as interest rates fall, right? So that's one to think about as well. And beside dividend yields, right, the payout per share you own can increase over time, right? So as share price rises, dividend yield rises or stays stable, the amount you receive per share can also increase, right? So that's another how you can participate in corporate earnings growth through time, growing dividends.
Mm-hmm. Now, one potential risk for dividend investors is the dividend traps, right? So, whereby I guess for those who don't know about this, this occurs when investors chase companies that pay high dividend yield, but then these could be troubled companies potentially, which may not be able to sustain the dividend payout. So with this scenario, Chris, how can our active investors potentially avoid these dividend traps?
So a common misunderstanding in our mind, in our perspective, is dividend investing is easy, right? Open a spreadsheet, filter all your stocks by yields, and just buy the high yielding ones. But dividend investing in our mind is more than that, right? Certain stocks, while they may pay currently high yields, can be unsustainable. So for example, a commodity firm may pay high yields when commodity prices are high, but when commodity prices go low, this dividend has to come down, right? Because they can't pay you as much. So that's not really what you want as a dividend investor. So when we invest, we look for stocks that can pay attractive level of yields, but more importantly, grow these yields over time. So you see the chart on the left, we do spread out our exposures in dividend yields, right, across our portfolio, right? And on the right, to avoid value traps, what we really focus on is company quality, companies that can consistently generate cash, have catalysts ahead of them, and importantly, valuations trade with a margin of safety. So before you on the right, you do see a few companies which we have in our portfolio. The names are masked, but they are companies which have good business, recurring cash flow, stable business, often not very much linked to the economic cycle, and that allows them to pay good dividends and grow them. Just give you one example. For example, on the extreme left, there is a company that supplies information services data to fields of academia, medicine, risk, etc. High recurring barriers to entry, because once the system is linked up with their customers, customers are reliant on their data, they remain very much entrenched. They pay subscription, long-term contracts, good cash flow, stable profile, right? And so that allows them to pay good growing dividends and over time grow earnings and stock prices as well. So that's an example of a company we like as a defensive dividend stock, right? So there are other examples for you to really just briefly go through after. And on the next slide, that also means when we build our portfolios, when we pick stocks, we avoid stocks names on two extremes. So one, the deep cyclical names, like I discussed briefly, commodity banks, their outcomes tend to be very much macro linked, which can be a bit hard to forecast, right? So we don't want that as a dividend investor. On the other end, high growth, high multiple, often loss making or no dividend, non-dividend paying names. So we tend to have little of that. So where we find the sweet spot as a dividend investor, the center portion. So the quality defensive names I just alluded to a slide before. And on the next slide, because of the defensive nature of some of these names, there is an additional benefit to it. They can be quite defensive, right? So for example, consumer staple companies produce toothpaste, soap, very insensitive to the economic cycle, right? And that means when recessions come, and they do come time to time because of the natural event of things as an economy matures and all, they add defensiveness to portfolios. So in the chart before you, in periods of recession, the grayed out bars, defensive stocks tend to do much better than the market, right? So a good statistic to really remember, over the last 6 recessions, sectors like staple, healthcare continue to grow earnings. And that is really how it adds some value. It diversifies your portfolio as well.
Mm-hmm. And last question before we go into the quiz giveaway. Now, Fidelity runs a successful global dividend strategy with over 10 years of track record. And the strategy has grown over US 13 billion from what I'm seeing right here. Now, Chris, could you just share a little bit more on how Fidelity picks what dividend stocks to invest in? I know a lot of them are coming in with questions on this in particular.
So maybe let's hop on to 39. We talk about returns here. So long-term returns, you see our fund in blue versus peers in yellow. We've done much better, right, with lower volatility. Now, while you also observe we have done a bit lesser than the market, it's been because of the narrow breadth I've described a bit earlier in this conversation in the market. US stocks, they tend to pay little dividends or no dividends, so we have less US. That hasn't helped. Tech stocks, because of the nature of those stocks and our strategy, we want to be dividend paying. Tech stocks tend to pay little to no dividends and are expensive, so we avoid those. That hasn't helped, but we have delivered much less volatility than the index. So it's kind of very different from the index. Also, lower volatility, it helps to diversify exposures in your portfolio. That's really how it adds value to a diversified portfolio, this strategy. On the next slide, so from a allocation geographical perspective, right, we have less US, I described, more in Europe, where valuations lower, dividends higher. And on a sectorial perspective, where we have less allocation IT, right, for the reasons I described, where we have more exposure in financials, not in banks, but exchanges, asset managers, or for example, staples, utilities. That's where we have more weight than the index from a sectorial perspective. And on the next slide, so here just speaks a bit to our approach. So you do see the donut chart on the left. We have much more in defensive sectors, a lot less linked to the economic cycle, making them more resilient. On the right, less mega cap stocks, no mega cap stocks, in fact, no Magnificent Seven, no banks, no commodities. So very defensive like portfolio, right? And on the next slide, I believe that's my last one, how we're positioning as a portfolio, how we're positioned right now, just over 40 stocks. Again, very high active share, meaning we are very differentiated from the index. Beta is lower than the market, which also suggests we are less volatile, less impacted by market movements on a day-to-day perspective. So with that, again, I hand it back to you, Olivia.
Thank you, Chris, for the first half and also sharing your insights from Fidelity International's perspective and also just from your expertise within this space. Now, we covered beyond technology stocks, but also we highlighted the core aspects of that and also the global outlook and also very comprehensive guide right there. If you missed any of those parts, especially for those who just joined us, don't worry, the replay will be available in the app and you can scan the QR code at the end of the show or even just after the show ends to rewatch some of the key parts that you missed out, both on YouTube and also in app, wherever you're tuning in from. Okay, so if you're ready for the first quiz question, and Chris,
Way, no, the answer is true, I guess.
absolutely. Okay, congratulations to the winners. The teams will be in touch. And of course, remember the mechanisms from before and do redeem it accordingly. Okay, congratulations. Thank you, Chris. Now, I'm going to show them how they can apply what they learned on the app very quickly. Now, Chris will be back with you with the key questions that we have prepared. See you shortly. So with everyone in the app, do follow me with this pathway right now because I'm going to show you how exactly you can access this in the app to apply what you learn. Okay, so it's really important, as always, and I emphasize this in every live show, that you do not just take the knowledge, but to really implement it for yourselves if you're interested. Okay, so if you go in the app, it's pretty straightforward. Okay, you go to Discover tab and make sure it's updated to the latest in the App Store or Google Play. And you go to Discover, you click on Wealth, and right here you can see under Fund Houses, you've got the list of available fund houses. Okay, so for the purpose of today, we're going to use Fidelity International. So if you see over here, you got Fidelity, you've got all the available fund names right here, everything available for you. Okay, so for the purpose of today as well, we're going to use the Global Technology Fund, for example. But again, the choice is up to you. Okay, there's so much that you can really look into, especially in the app. And I know I get a lot of questions on this, on how much there is in terms of possibilities. But of course, when you listen to all these live webinars and stuff, you have to really prioritize for yourselves, right? On what you want to focus on depending on your time horizon. So let's say we go into this, you can see over here, this is the overview. And again, like what Chris shared, right? All the trends, all the different charts, we've got that in real time right here for you. And just in particular for this fund and how it's doing. So you can see here, you can adjust the time horizon accordingly. You can see the historical returns, the NAV right here. We've moved it down below here with a lot of product updates. It's always improved just for your experience, and making sure that you can customize accordingly. Okay, so over here you can see their position details. I know that Chris also touched on a little bit for this, but if you look at the comments right here, that's where you can see the interaction with the community and what people are saying about it, especially with the news that is related to this fund. So everything is pretty much an ecosystem for you, right? So it really depends on what you are focusing on at the moment. If you look at analysis, you can see here what it is the composite of that portfolio. You can see the sectors, the regions, maturity, bond type, and also asset class for the first tab. And really, if you go down, you can see more information. There's just so much, right? Over here. But remember that essentially with all this information, the final tab under summary is where you can get all the fund documents for further details. So you just have to click on whatever you're looking at, especially with the updated ones going into the second half of the year. And you can just see for yourselves whether or not you are interested in it. Now, if you're done with it, and this is what I always do as well, I always add it onto my watch list with this heart at the top right hand corner. But essentially, once you add it on, it's on that list of what you're able to track daily when you open it, right? Open the app, of course. So if you're ready, definitely go back to the beginning page that I took you to. You can just click on subscribe right here, right? So of course, some investors might get this pop up. You just have to do the assessment before you go into subscribing it for yourselves once you input the amount. Okay, so that's essentially a summary and pathway of how you can subscribe to this particular fund. But of course, you can see the full list right here under Fidelity International. Now, let's welcome Chris back onto the floor, please. Okay, so before I ask my first question, we've got a lot of burning questions for you, Chris. Let's go into the second giveaway, okay? So I hope everyone has that knowledge fresh in their heads. Now, the second giveaway will be a tech-related question as a hint, but again, only the first few fastest fingers and those who get it right will be rewarded. Are you ready? Type in yes. Are you ready for quiz 2? I need to see many yes. Yes, keep it coming. And we're going to start with quiz 2 in 3, 2, 1. How many days did it take ChatGPT to reach 1 million users? Is it A, B, or C? It's not a yes or no question. It's a A, B, or C question. You have to type in the correct answer. Okay, we got a lot of different answers here. I'm going to give you 5 more seconds, okay? Is it A, B, or C? Okay, now Chris, what is the correct answer?
It's a little bit tougher than the first one, no?
Yeah.
The correct answer is C. 5
Yes,
days.
the answer is C. So those who answered 5 days, congratulations. And of course, the first ones that actually did it. Yes, that was, I really love that question. Now we're going to take some questions from the audience and stay till the end, okay? Because that's not the end of the quiz giveaways. We got a final one towards the end of the show. Now, the first question for you, because we ended off with the dividend portfolio topic. Now, Chris, someone would like to know, and just any tips for the investor listening on how to create, from a strategy perspective, a diversified dividend portfolio, or at least just share some summarized perspectives from your end.
So what I would first share is what you should not do as a dividend investor, right? So like I mentioned, don't just go out to a spreadsheet, put the dividend yields of all the stocks in the market and filter by yields and buy the top, whatever, 3, 5, 10 of them, right? Because very often these yields, you need to examine whether they are sustainable. While they are high now, it's a trailing measure, by the way, if you look at yields that way. It's high now, but it may not be sustainable for various reasons. It could be because of macro reasons, like I mentioned, a commodity firm. If energy prices go down, they may not pay as high in the coming quarters, right? Or it could be a one-off, right? Dividend, etc. So these are things you want to be careful about. So how we do it, we use a simple ABC philosophy. So A, we look at companies with attractive dividends, but they must kind of be able to grow dividends consistently, good dividends now, and can grow them. So there must be a pathway of earnings growth and dividends growth. Be better quality companies, right? So they must be of good quality, good management, good balance sheet, not over leveraged. That's one we look about. And then C, of course, kind of valuation. So we want to make sure, so A is attractive valuation, sorry. So make sure that valuations are attractive. You're not overpaying for valuations. So 3 factors, think about kind of fundamentals, valuations, and the ability to pay high, but more importantly, grow dividends through time.
Absolutely. Thank you for that. Now, the next question, so related to the Fidelity Fund, for example. So could you just clarify which Fidelity Fund focuses on these mid-cap and growth companies?
So the one that we have as our flagship technology fund globally is the Global Technology Strategy.
Mm-hmm. Okay, thank you for that. And of course, we highlighted also in the app tutorial on the list of available ones. So do check it out for yourselves. Okay, and there are many pathways to get to that tab of funds. So definitely explore the app for yourselves. Okay, the next question is about, the revelations within the global election space. So any thoughts and implications of maybe the US elections and just in general for the world on the technology stocks and also just the up and coming trends that you shared?
Yeah, so that's a good question. So half of this year's of the world's population was projected at the start of the year to go into elections this year. Still a number coming up in the rest of the year. So elections, I think we are by far no political experts, right? So we don't claim to be able to project an outcome. But what we can say is markets during electional periods, they tend to make calls whether who will win, what the outcome might be, what the impact might be. But when you stretch it out beyond the periods running into and out of the election, markets tend to move on and up most of the time, right? So really the focus here is to look beyond the short term to the medium and long term to really look out for winners that can, whether you're going for a technology strategy or a dividend strategy, focus on companies' fundamentals, valuations, etc. So that's really what I would advise going through the rest of this year from an election perspective.
Mm-hmm. Thanks for that. And on the topic of US market, now how will the delay in US Fed rate cuts affect technology stocks and mutual funds in general, from your perspective, of course? And the second part of that question is, as an investor, are we focusing too much on these mega tech stocks? Is a bubble coming, perhaps?
Yeah, to your first question, Olivia, I think interest rates or bond yields more specifically have the ability to impact directions of stocks, valuations of stock in the immediate term. But bearing in mind this year, just look at 2023 to 24, right?
Mm-hmm.
So at the start of this year, everyone was expecting 6 to 8 cuts, I recall. Right now, 1 to 2. And what have tech stocks done? They continue to grind higher. So it can impact valuations. It has historically done so, but so far it hasn't really had that big an impact. What has driven more, I think, is earnings expectation. So with markets arguably not as very cheap, they are probably fair, in some spaces expensive, earnings will take over and drive kind of where stock prices and the market will go. And it's important here to really look at fundamentals of each and every stock that you invest in. So that's what we do in our fund. Make sure there is an earnings trajectory. We look out for earnings, look out for fundamentals. I guess that's what you want to pay a bit more attention rather than where bond yields or interest rates go in the next 1 to 3 months, for example. So
Mm-hmm.
that's how I would look at it from an interest rate perspective. Olivia, what's your second question again? Sorry.
So the second question then, in terms of, because we talk so much about technology and also investors online, they're some of them think that they're focusing too much on the mega tech stocks themselves. So, in terms of this and taking this perspective, what can they do about it? And
Yeah.
is a potential bubble coming? Is there something in terms of risks that they should be looking out for?
Yeah, that's a good question. So I would say that I've tried. I hope you got that through a big part of my early conversation, right? That markets have been relatively concentrated. The concentration rather is at pretty low points or high points rather through a long-term market cycle. So for example, last year, 27% I mentioned of the stocks in the S&P beat the market, when on average through time, it's about 40 plus percent. So really, it's been very concentrated, right? It's not to say that fundamentally some of these companies that have gotten all the flows, the large mega cap companies, are poor. They're fundamentally good, but valuations are a bit more rich. Everyone's very crowded in there. So expectations are high. The risk of them missing an earnings expectation, for example, or maybe guiding something lower and subsequently seeing a share price come down is increasingly high, right? As everyone gets very crowded in them. So what you want to think about, and we're thinking about it in our tech strategy, for example, is to broaden beyond these names. We do have some of these names selectively, but with the other capital, we're going into areas where no one is thinking that hard about. Small mid caps is one I mentioned, for example. Tech hardware linked to the 5G trend in emerging markets, another area we're spotting digitization or even looking beyond the obvious, right? So I mentioned the example of the aircraft engine manufacturer. So these guys are using technology to improve outcomes, yet markets are not fully appreciating what they're doing. So opportunities also reside outside the obvious. So that's what we're doing, spreading, going beyond large mega caps, where valuations are a lot less demanding, expectations lower, investors not so much crowded in them at this present moment.
Mm-hmm. Thank you so much for answering the burning questions from our users on the show today. We had many, many more questions, but of course, we picked the top ones that are relevant to today's topic. And also, Chris mentioned it before. If you missed out any points that he shared in his slides before, do check out the replay right after this. Okay. So again, if you're ready for quiz 3, type in yes right now. And I asked in the chat box as well, who's coming for MooFest this year? A lot of you are coming, so that's great. And we'll share more info later on if you don't know how to get there. To the sign up page, of course. Okay, a lot of people are ready. It's a yes. Okay, quiz 3. Chris, I'm going to get you to answer the correct answer for this. And in 3, 2, 1. By 2050, the 65 plus population is expected to go from 720 million to 1.5 billion people. True or false? Wow, many people answering. You got 5 more seconds. This is your final chance. True or false? Okay. And Chris, what is the correct answer?
That's true.
It's true. Congratulations to everyone who participated in the quiz. And thank you, everyone. Okay, I mean, some people even put in false just in case. That's actually pretty funny. Thank you again for interacting with us and being a part of the live shows. This is the first of the many that we have for you these 2 days. Okay, so sign up for the next one. I'll share more information later on. Now, Chris, as we wrap up and go into final statements, what is that final giveaway and takeaway for everybody right now?
Yep. So I'm gonna really wrap up what I spoke about today, right, over the last hour. So growth, from an economic standpoint, looks resilient, but headwinds are growing and really worth monitoring, right? On the positive side, inflation's coming down, and that should allow the Fed to start cutting interest rates, markets expecting this year. So with interest rates coming down, investors maybe can start thinking about putting a bit more cash to work, of course, within your risk budgets and your allocation, right? Still some uncertainty in the horizon, so it's prudent also to be diversified. The rally so far this year, very narrow. You maybe want to think about diversifying, going beyond the winners of yesterday, right?
Mhm.
Many other areas, a lot less crowded, valuations a lot more attractive. So maybe you also want to diversify your exposures from that perspective and really look at fundamentals, earnings growth, and kind of valuations that you're paying. So really, that is my message to wrap up what I spoke about today.
And that was Christopher Wong, everyone, client portfolio strategist at Fidelity International. Thank you so much, Chris, for sharing your insights for the past hour and also being such a good sport with the quiz giveaways. We cannot wait for our next show together. So hopefully next time, and we'll see you next on our live shows. Thank you, Chris.
Thanks. Bye, everyone.
To everyone listening, here are the QR codes for you. Do follow us if you want to keep track of the replays and also the next show that we have for you. There's so much content out there. On the left, you can see the QR code in app. If you want to follow me right now, you can even just, I've been typing and chatting with you on the live. So do follow us so that you can just be in the know of the next show and also the upcoming content that we have for you. And on the right are our social media channels for everyone who wants to just join the Telegram or the TikTok, Instagram, Facebook, Twitter, YouTube. They're all there. Okay. So scan the QR code if you want to find out more related to this. And next up, of course, where this show is ongoing in app, follow us for sure. If you're on the Moo Rich tab, definitely give it a follow because this is really important to keep track of these fun live webinars and also information about not just the shows, but anything related to markets and Moo Fest. Everything will be posted right here. Okay, so give us a follow on Moo Rich as well. And information about the next show, okay, that's happening later on today. So definitely book in right now, whether it's in app or on the YouTube channel. You can just notify yourselves. Now, this will be a different topic, but at the same time, the mechanics are the same. We'll also have potential giveaways for you. So if you missed out your chance today, you can do so later on, okay? And of course, the long-awaited, anticipated event of the year, MooFest 2024. Definitely join now. There's so much information in the app right now, and the team will just drop in the link for you. This is where you can win attractive prizes and also gain investment insights from a more in-depth perspective. And I'll be there as well, and I cannot wait to greet some of our community members in person. So definitely say hi when you're coming down, and of course, take lots of pictures, and it's going to be a really exciting event. So definitely join now. You've got to sign up, okay, for you to be able to access the event. Okay, so hopefully we'll see you there. So we'll see you for the next show, everyone. Thanks for joining us for the first of many, and we'll see you for the next show later on today. In the meantime, have a great lunch wherever you're tuning in from, and we'll catch you later. Once again, I'm Olivia Higgins. Okay, perfect. Thank you. All right, Chris, thank you for your time and for your energy too.
My pleasure. Hope it went well.
Yes, it will keep you posted. And are you coming for the event?
Not sure. I'll work with Shuangwei.
Okay. Well, hopefully I'll see you soon. If not,
Hope to
let's
see you
really
soon.
try to catch up outside of that. I think that'll be great.
Yeah, I mean, it'd be good to meet face to face for once.
Yes, finally, gotta make it
Finally, yeah.
happen, okay?
All right.
All right. We'll see you soon.
Okay.
Bye.
See you guys. Bye bye.
See you later.